Europe has quietly built a carbon market squeeze that's so mechanical and mandatory, most investors are still sleeping on it. We're breaking this down plain and simple. What's happening, why it's going to keep pushing prices higher, and how you can actually play it. The EU Emissions Trading System, or the EU ETS, is still the biggest, most liquid carbon compliance market on the planet by trading volume and money moving around. We're talking 700 to 800 billion euros a year. Power plants, heavy industry, airlines, and now shipping have to buy and surrender EU allowances for every ton of CO2 they emit. Miss the deadline? Massive fines. For 2026 auctions, the EU just revised the calendar. They're pulling a net of 52 million allowances off the market because of the maritime phase-in adjustment. Real supply, gone. Shipping companies have to surrender for 70% of their verified 2025 emissions in 2026, then 100% starting with 2026 emissions. And from 2026, it's not just CO2 anymore. Methane and nitrous oxide get included too. They either buy EUAs or get hammered with penalties. Supply is legally capped. Demand is legally forced. Then you throw in the Market Stability Reserve. When prices climb or there's too much surplus, it automatically sucks hundreds of millions of allowances out of circulation forever. Scarcity feeds on itself. Forget what speculators are doing. They're just along for the ride. The real price is set by utilities, steel mills, cement plants, and now shipping companies who have to comply or die. When EUA prices hit the high 80s, these guys start hedging hard ahead of surrender deadlines. Liquidity dries up, volatility spikes, and the price rips because it's not optional. This is why a lot of traders get caught flat-footed. The upside here isn't Twitter hype. Instead, it's legally mandated buying pressure. Here's the real ways to play it. 1. Direct futures. This is the cleanest play for pros, but retail can do it with the right setup. ICE EUA December 2026 contract. This is the main one that captures the 2026 squeeze. EUA calendar spreads to isolate the scarcity. UK allowance futures. Same dynamics thanks to linkage. Then you have ETFs and ETNs. This is the easiest for retail. KRBN, Global Carbon ETF. Heavy on EUAs and UKAs. Smaller IPATH/ICAP ETNs. Track EUA futures directly for tactical moves. Equity proxies. This is the simplest retail entry. No futures drama. Big European utilities like RWE, E.ON, Engie. Higher EUA prices equals higher costs, but they pass it on and sometimes profit from hedging. Industrial emitters, cement like Heidelberg Materials, steel like ArcelorMittal, chemicals, forced buyers. So prices going up hurts margin short term. Timing matters. Keep an eye on auction volume updates. EEX publishes them weekly and monthly. MSR adjustments. Prices rise means more allowances get invalidated. Forward curve going into backwardation. That's an early hedging signal. Shipping compliance deadlines. Late buyers always spike the spot. Any UK and EU linkage news tightens the arbitrage. These are regulatory triggers. When they hit, prices move fast. So bottom line is Europe created a supply-demand imbalance that's 100% baked into law. Supply is fixed and shrinking. Demand is mandatory and growing. MSR makes it worse. This is a boring, mechanical trade, and it keeps working while everyone else chases the next shiny thing.